From the Basel II Compliance Professionals Association, the largest association of Basel II professionals in the world.
According to the Bank for International Settlements, reputational risk can be defined as the risk arising from negative perception on the part of customers, counterparties, shareholders, investors or regulators, that can affect a bank's ability to maintain existing or establish new business relationships, and continued access to sources of funding.
Reputational risk is multidimensional and reflects the perception of other market participants.
It exists throughout the organization, and exposure to reputational risk is essentially a function of the adequacy of the bank's internal risk management processes, as well as the manner and efficiency with which management responds to external influences on bank-related transactions.
Reputational risk, typically through the provision of implicit support, may give rise to credit, liquidity, market and legal risk, all of which can have a negative impact on a bank's earnings, liquidity and capital position.
A bank should identify potential sources of reputational risk to which it is exposed.
These include the bank's business lines, liabilities, affiliated operations, off-balance sheet vehicles and the markets in which it operates.
The risks that arise should be incorporated into the bank's risk management processes and appropriately addressed in its ECOP and liquidity contingency plans. Prior to 2007, many banks failed to recognize the reputational risk associated with their off-balance sheet vehicles.
In stressed conditions, some firms went beyond their contractual obligations to support their sponsored securitizations and off-balance sheet vehicles.
A bank should incorporate the exposures that could give rise to reputational risk into its assessments of whether the requirements under the securitization framework have been met and the potential adverse impact of providing implicit support.
Reputational risk may arise, for example, from a bank's sponsorship of securitization structures.
It may also arise from a bank's involvement in asset or funds management, particularly when financial instruments are issued by owned or sponsored entities and are distributed to the customers of the sponsoring bank.
In the event that the instruments were not correctly priced or the main risk drivers not adequately disclosed, a sponsor may feel some responsibility to its customers or be economically compelled to cover any losses. Reputational risk also arises when a bank sponsors activities such as money market mutual funds, in-house hedge funds and real estate investment trusts.
In these cases, a bank may decide to support the value of shares, units held by investors even though it is not contractually required to provide the support. Reputational risk may affect a bank's liabilities, since market confidence in a bank's ability to fund its business are closely related to its reputation.
For instance, to avoid damaging its reputation, a bank may call its liabilities even though this might negatively affect its liquidity profile.
This is particularly true for liabilities that are components of regulatory capital, such as hybrid, subordinated debt. In such cases, a bank's capital position is likely to suffer.
Bank management should have appropriate policies in place to identify sources of reputational risk when entering new markets, products or lines of activities.
In addition, a bank's stress testing procedures should take account of reputational risk so management has a firm understanding of that consequences and second-round effects of reputational risk. A bank identifies potential exposures arising from reputational concerns. It should measure the amount of support it might have to provide, including implicit support of securitizations, or losses it might experience under adverse market conditions.
In particular, in order to avoid reputational damages and to maintain market confidence, a bank should develop methodologies to measure as precisely as possible the effect of reputational risk in terms of other risk types, credit, liquidity, market or operational risk, to which it may be exposed.
This could be accomplished by including reputational risk scenarios in regular stress tests.
For instance, non-contractual off-balance sheet exposures could be included in the stress test to determine the effect on a bank's credit, market and liquidity risk profiles.
Methodologies also could include comparing the actual amount of exposure carried on the balance sheet versus the maximum exposure amount held off balance sheet, that is, the potential amount to which the bank could be exposed.
A bank should pay particular attention to the effects of reputational risk on its overall liquidity position, taking into account both possible increases in the asset side of the balance sheet and possible restrictions on funding, should the loss of reputation result in various counterparties' loss of confidence.
To learn more, you may visit the reading room of our association.
There are great papers and information for the implementation of the Basel II framework in the world.
Join the Basel II Compliance Professionals Association. Membership is free.
Read the monthly newsletter and stay current.
Become a certified Basel II professional. Provide independent evidence that you're an expert.
I hope you will join us. You may leave any time. We will respect your privacy.
Thank you.